Greetings, Edyard Denny here. Thanks for joining me today. Always something going on in the global economy, global geopolitics that we need to think about and incorporate into our thinking about investing. Before I go there, let me just tell you we've got two special guests here today. They don't always come here, but occasionally they do. And let's see if, yeah, we've got Max and Bailey. I'm having a hard time figuring who's who. They're not twins. We just happen to buy the same looking dogs, as you can see. But the puppies are having a good nap here. As I said before, they seem to find my presentations very relaxing. So they fall asleep. I hope you don't, and I find you find that I have something of value to add to your decision-making process. But enough of that. Let's start out with the geopolitics. It's a horrible, horrible situation in the Ukraine, where the Russian forces seem to be inclined to level some of the major cities in Ukraine. Deaths and destruction, injuries are awful, and so are the people that are being forced to flee. So it's a miserable situation. It's hard to watch it, but clearly the people on the ground there are suffering tremendously. I hope that you find somebody, some useful and appropriate charity to contribute to support these folks who basically are losing everything. Now, over the weekend, according to first the FT and then some other reports, we saw that the Russian forces were continuing to take a toll on Ukraine. And we saw that the Russians apparently need some help. I don't know, they reached out to the Chinese and asked for some weapons and some financial support. So I guess they're trying to get the Chinese to make good on their February 4th partnership agreement. That was where President Xi and President Putin met before the Olympics and came up with this joint statement, basically saying that they're BFFs, best friends forever. I think the Chinese may already have some regrets of being that visible with that partnership agreement, with the two of them shaking hands. But on the other hand, this is clearly an agreement to work against the interests of the West. It's a protest by authoritarian tyrants against democracy. So this is going to be a partnership that's going to last. But the Chinese obviously have lots of interest in the West, particularly in exporting to the West. They don't want to be a pariah nation. So it's not clear how they're going to respond to the Russian requests for some assistance here. Meanwhile, we have seen that the price of oil has come after skyrocketing over 100, is now back to roughly 100. And that has something to do with the United Arab Emirates a few days ago declaring that they would like OPEC to consider producing more. Russia is part of OPEC +1, but OPEC certainly has some interest here in meeting the very urgent requests of the West to provide more oil. And that's clearly in the interests of those countries not to cause a recession in their major markets. So all in all, that was a promising development. On the other hand, as you know, President Biden's been hat in hand going around the world trying to get tyrants to produce more oil, like in Venezuela and the autocrats in the UAE and Saudi Arabia. But he's met limited success so far, but maybe the UAE announcement will change that. But meanwhile, he also, I think there was some hope that we'd have a deal with Iran pretty quickly here, and that Iran would be producing more oil. And then Iran goes and lobs several missiles at Iraq, not too far off from where American soldiers were. So I don't know if the Biden administration is going to recognize that Iran is a threat and we shouldn't be kowtowing to them. But on the other hand, they seem to want this deal awfully bad. So we'll see how that all plays out. Meanwhile, the markets, the key word, of course, is volatility. They continue to be volatile. They seem to go up a lot one day and then down a lot the next day. Past few days, there have been some strength on news that perhaps the Russians and the Ukrainian negotiations are going better, but that doesn't really mean much at this point. But again, the markets are looking for any good news to rally, and as they do so, it looks as though there's still some folks who are taking opportunities of rallies to sell and lighten up on some of their positions. Whereas when the thing takes a dive, you see some of the dip buyers coming in. Still, I'm recommending. I'm still of the view that this is a bull market, but I think this will be a tough year. We thought for a while that it would be a tough year in the extent of kind of being flat around 4,800 with a lot of volatility around that flat trend. And then a couple of weeks ago, we lowered our target, our low to 4,000. I don't know if that's going to happen exactly at the end of the year or if it's going to happen in the next few weeks. But the basic thing that changed for Joe and I is that Debbie and I came to the conclusion that inflation is going to be higher, longer, more persistent, and that supply chain disruptions may be getting ameliorated to some extent, though there's a lot of uncertainty about the extent to which we're going to have problems related to Ukraine. Apparently, there's a couple of plants in Ukraine that produce 60% of the world's neon. And neon is important for lasers and semiconductor production. But then again, according to some articles, the semiconductor industry knew some problems could be occurring in that regard. And so they've stockpiled neon gas and some other components, I guess, that Ukraine and maybe Russia provided to the industry. So I just don't really think the supply chain disruptions is really the key issue here now when it comes to inflation. I think we're beyond that, and I think we're looking at a wage price spiral that I think was worsened by the Ukraine crisis because it did push oil prices up. It did push gasoline prices up. Maybe they come down some, but everybody's complaining about what they're paying for gasoline. Though everybody's saying that maybe the price we have to pay for what's going on in the Ukraine, and then of course ag prices have been going up a lot. But then again, wheat went straight up, oil went straight up, and then they came back down, but not all the way back down. They're still quite elevated. So looking at the Atlanta Fed's wage growth proxies or trackers. We're seeing more and more elevated inflationary pressures in wages. The real problem on the inflation side, to a large extent, is a shortage of labor. And wages are going up as a result of that. And I think that will be offset by productivity, but it takes a while for that to happen. I think companies only recently, over the past year, came to realize that the shortages in the labor market are chronic. They're not just pandemic related. And as they're coming to terms with that, they are scrambling to spend on capital equipment, on technology. We see that in non-defense capital goods orders soaring to all-time new highs. And I think that continues, and that's an important consideration for what the prospects are. That's all leading to a recession. Before the Ukrainian crisis, I think very few of us thought that a recession was very likely this year or even next year. But now, if inflation is going to be more persistent, it's going to be higher, then that raises the possibilities that that will erode consumer confidence, as we've seen it is already, that it will erode consumers' purchasing power, and that will weigh on consumer spending. But on the other hand, inventories are still relatively low, so they could be built up. We've got capital spending looking extremely strong. And so it's a mixed picture, but I think, as I said, I don't know if I use the noun that we're in stagflation. I would use the adjective that we're seeing a more stagflationary environment as a result of the Ukraine crisis. And that means slower growth, maybe 2% instead of 3% for a while. It means higher inflation, and we can look at that in the chart. So let's go to the charts. And again, what's changed for us is the inflation outlook looks grimmer. Let me see if I can magically pull up my charts here. Good, we got it. Let's go here. So the morning briefing focuses on inflation, liquidity, and inflation, liquidity, and valuations. So the question is, we were thinking that with so much liquidity in the system still left over from the past 2 years of ultra easy fiscal and monetary policies, that would keep valuation multiples relatively high. Well, reality bites here, and you can see that the forward PE ratio was fairly range bound between 20, let's say, and 23, roughly, or 22. But then since the beginning of the year, end of last year, we've really seen the valuation multiple come down hard. So it was around 2022, and now we're at 18.3, and that was on Friday. We're kind of back to where valuation was at its peak before the pandemic, and it's still relatively high. And in an environment where inflation is going to be higher and more persistent than we thought anyways, we think that there's a possibility here for the multiple to continue to shrink down to 16. But clearly, as I've written in the past, I wrote it up in my 2018 book, valuation is kind of like beauty. It's in the eyes of the beholder. And the relationship between valuation multiples and interest rates and inflation rates is a complex one, and not one that is necessarily predictable or easy to see consistency. But let's give it a try. So again, the pre-Ukrainian crisis story we were telling is that if you extrapolate this line here for M2, you get something like $3 trillion in what appears to be excess liquidity that could continue to go into the stock market and keep valuations propped up. That story is still there. The liquidity is still there. It hasn't gone away. The story that the CFO put is out there to replace the Fed put. That's still very much in play. So we want to keep that in mind. It's not like that suddenly went away. What came back with a vengeance, or what was out there and now I think is going to continue to be worse, is the inflation. And we know that the CPI inflation rate in February was 7.9%. So that clearly implies that we're going to see higher consumption deflator, headline, and core. These are the measures that the Fed prefers when it looks at inflation. And so we raised our peak to 6 to 7%, from 5 to 6% for the first half of this year, so 6 to 7, and then we brought it down to 4 to 5 by the second half of the year, and we were using 3 to 4%, and 3 to 4% is what we're using for next year. Still trying to be optimistic that this is not going to be a great inflation of the 1970s. But as you can see, these numbers are higher than the ones we had before. We're not likely to get down anywhere near 2% this year. It's going to be still elevated, putting pressure on the Fed to continue to raise rates. And we think they're going to still do it gradually, and we'll get 25 bips, not per meeting, but we think enough to get 1% on the Fed funds rate by the end of the year. And then within this context, maybe 2% by the end of next year, but we'll talk again before then. As you can see, 3 to 4% is still well above the Fed's 2% target. And again, I will not be surprised if they feel that they've made so much, accomplished so much by bringing it down to 3 to 4%. Let's say they really luck out and get to 3. I will not be surprised if they raise the inflation target to 3%. But that's down the road. For the here and now, let's look at the relationship between valuation multiples and inflation and interest rates. And the relationship is not a tight one, which is kind of frustrating, because it would be kind of nice if they were tight and we could use these relationships to forecast where the PE is going. But the PE, we have it all the way back to 1935. As you can see, from 1935 to 1978, it's based on reported earnings, so it's quarterly. And then from 79 on, we have weekly data, but it's too messy. So we showing it with monthly data for the forward PE, which is our preferred PE in any event. And as you can see, there is sort of an inverse correlation going on. It's not something that's very precise. It's inverse, but it's not an exact tracking model. And here we've seen inflation absolutely soar, and consistent with that, we've seen some air coming out of the valuations. There's nothing to say that where this is going from here. Maybe the excess liquidity means that it doesn't go any lower. Maybe the inflation and interest rate environment means that it is going lower. And we're taking sides here and saying that this year we won't be surprised if we see 16. And of course, that's something that could happen, in a blink, given the volatility in the marketplace. Now let's look at the same concept. This time we'll go back to 1953 because that's when we have the 10-year bond available. Before then, the Fed had a deal with the Treasury to keep them pegged. So this is a reasonable period here. And again, inverse relationship, but again, not a very precise one. And on the one hand, we see that, sorry to be a two-handed economist, it happens to me every now and then, but on the one hand, we just saw that inflation is a drag on valuation multiples. And on the other, we see that the bond yield is a bit of a drag, but it's not that much of a drag, given that we're still near historical lows or around 2%. But again, the inverse relationship is working. Stocks are a great hedge against inflation. Revenues go up with inflation. And if we take revenues divided by the CPI, you can see that the real measure of S&P 500 revenues has had an upward trend. So that's an encouraging development. If we look at the earnings equation, just because revenues are going up with inflation doesn't necessarily mean that costs aren't going to offset that. And you would generally expect that would be the case. But we find that when you take reported earnings going all the way back to 1935 and divide them by the consumption, by the CPI, you still get something like a 2 to 3% growth path per year in real earnings, which is really pretty impressive. And I think that's kind of makes sense that productivity has been an important contributor to earnings. So the fact of the matter is both revenues and earnings do beat inflation. So just because inflation's going up doesn't mean it's all bad for stock market. It's good for revenues. It seems like stocks can beat that with productivity. And so from a fundamental perspective, inflation is not a terrible thing for stocks. It's the question really is on the valuation side. And again, we've got this conundrum where, sure, inflation has an impact on the bond yield, but as you can see from this relationship, it's not exactly a perfect one. And they can diverge quite a bit as we're seeing right now. So this looks pretty bearish for valuation multiples right now. This looks kind of bearish, but less so. Meanwhile, the difference between the two is the inflation-adjusted bond yield or real bond yield, and you can see that it's the most negative it's ever been. So the Fed is way behind the curve, and from that perspective, if it really wants to catch up, it's going to have to raise interest rates pretty quickly here to levels that really could risk a recession and create a real problem for both revenues, earnings, and the valuation multiple. However, I think we've got a Fed that's not going to do a Volcker 2.0. I think they're going to come up with all sorts of explanations for why inflation is something that they can't necessarily deal with just interest rates, and that they'll blame it on geopolitics, and they'll come up with other excuses. But I don't see them stepping on the brakes. Another way to look at the relationship between inflation and the stock market is to do the real yield. In other words, instead of doing the PE, do the EP, the earnings divided by the price. That's the nominal earnings yield, and then subtract out the year-over-year CPI inflation rate, because we have it going back all the way to 1935. And you can see that there is this disturbing tendency, disturbing because we're seeing the real yield is negative, as it has been since the third quarter of last year. And there is a correlation, or there is a coincidence between real yields being negative and bear markets. Sometimes it's after the fact, but it always seemed to be in the neighborhood. A related concern is that why should we even pay attention to the real earnings yield? Well, if you correlate it with the leading indicators interest rate spread, which is basically the shape of the yield curve, 10-year minus the Fed funds rate, it also tends to turn negative at about the same time as the real earnings yield tends to go down. So what a relief, it's going up this time. So it's not confirming the negative real yield. But as we know that if the Fed has been extraordinarily slow in tightening, and the fixed income markets have figured that out. They figured out the Fed's going to have to raise rates. They're being a little slow about it, very slow about it. And meanwhile, the 10-year minus 2-year is doing this kind of routine. So I wouldn't ignore this. I think it's important. I've been sort of arguing that this is kind of rigged by the Fed's intervention in the fixed income markets. And maybe that is about to change because the Fed is going to stop its quantitative purchases of treasuries. But this is something that in line with this relationship suggests that there are some clear negatives for the valuation multiple. And speaking of that, there's the misery index, which is the sum of the inflation rate and the unemployment rate. It's not great. It's just, again, it tends to be going up as you get towards bear market. So that at least that's something to think about. And it's going up right now, but it's not much of a market timing tool. Here's the CPI versus the unemployment rate, which is the two components of the misery index. And you can see that the unemployment rate actually has a tendency to be a better bottom picker. If you know for sure that the unemployment rate isn't going to go any lower here, about there, then it did pick out bear markets pretty well. So the question is, with the unemployment rate at 3.8%, does it have a lot lower to go? The answer may be it does. It could very well get down into the twos, and given the labor shortages we have in the labor market. So here's another interesting chart showing the misery index versus the S&P 500 PE. Again, this time going back to 48. Again, inverse relationship, but again, the relationship is not real tight. But just as the misery index is going up, this is going down. So we need to respect those relationships. This is even a looser correlation, but it shows the consumer sentiment index, which is more sensitive to inflationary concerns than is the consumer confidence index. And you can see that this correlation is not inverse, but it's more positive. But all I can tell you is this is not particularly good for what's going for what we're seeing in valuation multiples. It confirms that there's a lot of pessimism developing about inflation. So there's other metrics of valuation like the PE and the PS ratio and those things. The PS is coming down. The reason the PS was much higher is because the margin has been much higher. Let me just take the robocall out of its misery. And then we're watching these on a daily basis. You can track them on the website, or we tend to report them almost every day these days because this is so important. So have a look at that on your own. It's the SMID caps and then this growth versus value valuation multiples. And that's all I really wanted to cover. I spoke a little too long. Let's see if we've got any questions here. I've got one. Go ahead and add some more questions if you like. Long-term credit spreads have widened to levels seen in the late 2019. Is this a problem now that U.S. Treasuries are selling off? Yeah, I think, as I've indicated before, there are a few high-frequency coincident indicators of trouble, and we'd certainly know that the VIX is one of them, and the VIX is highly correlated with the spread between is highly correlated between the spread of the corporate junk bond yield and the Treasury. So I'm always concerned when I see that spread widening, because it's a very good indicator, but it's not much of a leading indicator. By the time it tells you you're in trouble, or we're in trouble. So it is something to be aware of. Clearly, in this case, if we have the bond yield, the Treasury bond yield going up, but corporate yields don't, yeah, I mean, the bottom line is, I was about to confuse myself. Bottom line is, you're right. It's something to be concerned about. Thanks. And that was Doug. Okay, what are the odds of a recession in 2022? Well, I guess if you force me to come up with it, I'm going to just wing it. So don't quote me, because, well, you can quote me. I would say that for 2022 this year, if you asked me before the Ukraine crisis, I would have said maybe 10, 15%. Now I'd say it's more like 25%. So it's clearly not my most likely scenario. My most likely scenario is a stagflationary environment with about 2% growth and about 5, 6, 7% inflation, depending on which indicator you use for inflation. For the deflator, I guess I'd be looking at, as I said before, 6 to 7% immediately ahead here, and then easing down to, if we're lucky, 4 to 5% by the end of the year, and interest rates going up. Let's see, Mark, how does Joe Feshbach see the rest of the year? Yeah, Joe, my good friend Joe, we talk on a regular basis. He's a great trader. He's done very well. He manages just his own account, but Joe and I worked together at Prudential way back when. So he's got a real sort of technicians and fundamental sense and sentiment sense of the markets. And his view right now is that he's somewhat concerned that the put call ratio didn't go up much last week, or enough to convince him that we really saw a lot of capitulation. So he thinks there's still a potential here for the market to make a new low relative for this year, anyways. And then he thinks that could be the flush out that could lead to a rally. But it was late last year, early this year, that he started talking about the NASDAQ having made a major top. So he got that dead on right. And he's also been talking about just a lot of volatility. Dogs are getting restless. So let's see, where else are we here? Okay, Michael, do we know that the Fed only buys the 10-year? Is it possible they suppress the entire curve? They buy? Yes, absolutely. I mean, I think that's the case. They've been buying the curve across the board. We do have some charts on that. I'll put them in the morning briefing, maybe in a day or two. But what's changing is they're going to stop buying all across the board. So they will hopefully not be creating any more noise in the yield curve. David, okay, David, do you think we should be like Max and Bailey? Absolutely, and just snooze through the period of turmoil. My sense is that once this conflict ends, the market will turn positive from these levels. Yeah, I mean, if we wake up tomorrow morning and there's an announcement that we've got a ceasefire and a tentative final agreement that all sides are happy with, markets would rip to the upside, and then they'd recognize that the bond yield was also ripping to the upside, because now the Fed no longer has an excuse not to catch up in its lagging relationship to the inflation curve. And that would presumably unnerve the market. The Fed is so far behind the inflation curve that the only way that they're going to bring inflation down is the Volcker 2.0, and this Fed's just not going to do it. So I think we're going to have negative real bond yields for some time. It doesn't make for a happy investment environment for long-term investors, but that's what the Fed is doing, and that's its impact. By the way, on the inflation front, we're doing more work for tomorrow. We're talking about it and writing about it all the time. But we're really coming around to the conclusion, and you'll see it tomorrow and the next day, that rent inflation is going to be a real nightmare problem for all of us, for inflation and for renters and for the Fed. Is that a crystal ball on your desk behind you? Yeah, that's my crystal ball, and that's when I was pretty good. So it's all based on the crystal ball. Does it work? It used to work. We'll see. We'll see how it plays out. As you know, you can never. You always have to look ahead in these markets. Faisal, thanks for your presentation. Looking ahead, what are your thoughts about the U.S. economy in the next 6 to 12 months? If the situation in Ukraine does not get better or gets worse with the European Union members getting involved. Yeah, I mean, there certainly is a potential here for this war to last for a long time, even if the Russians manage to encircle and take over some of the key cities. Looks like the Ukrainians are going to be resisting pretty substantially. I think if it just stays localized in Ukraine, which it isn't anymore. I mean, it's spread to economic war for all practical purposes between Russia and the West and everybody else, to the extent that the West can have a pretty important influence on other countries by saying that, and they're doing this with China right now. They're telling China, if you give them financial aid and military aid, these sanctions are going to be tightened in our relationships with China. So it's already pretty much a world war in terms of economics, even though militarily it's still pretty much in the Ukraine. But if it's a long-lasting issue, it's going to keep oil prices elevated, wheat prices elevated. It could at some point create problems for some of the supply chains for neon and semiconductors, for all I know. And it could certainly cause a recession in Europe, which then would contribute to our stagflationary environment by depressing our exports to Europe. If it ends pretty quickly here and nobody's really happy with it, but at least nobody's getting killed and nobody's dropping bombs on Ukraine anymore, then as you said, I don't really want to talk about snoozing when all these terrible things are happening, but just accepting the volatility that this year will be a volatile year, and maybe I'm hearing a lot of, I guess the new consensus view is that I'm hearing on the talking heads on TV. I guess I'm a talking head every now and then, but it seems like the consensus talking head view is it's going to be volatile the first half of the year, and then we should be doing better in the second half of the year. But my problem with that is we're going to still have an inflation problem that was just exacerbated by Ukraine. But underlying it all, I think there is a basic problem with the wage price spiral that's spiraling, and I'm waiting for productivity to really kick in sufficiently to stop that. But I'm kind of seeing it in margins and corporate profit margins holding up. But stay tuned. We'll in tomorrow's morning briefing, we'll be addressing that, and the following morning briefing will be Melissa's doing a lot of work on rent, and it's not a happy story unless you're a landlord. Let's see, we'll take another couple of questions. Okay, with your prediction of 4,000 S&P by end of year, what do you recommend for investments that hedge against inflation and supply chain disruptions? Well, we've been saying overweight energy as a hedge against inflation, overweight financials as a hedge against rising interest rates, and overweight information technology as a play on the roaring 2020s. I'm already getting some flack here and there that, it doesn't feel like the roaring 2020s anymore, does it? Well, I mean, clearly it doesn't, but I have some time left between. I guess history will judge that prediction at the end of the decade. I hope I'm still around, not run over by a bus or anything. But at the end of the decade, we can look back and say the roaring 2020s made absolutely no frickin' sense, or we can say that it worked out pretty good. It just started out badly. Okay, I'll take one more because we're over the half-hour quota here that I try to keep out of respect for your time. Index funds are agnostic to price going up and down. Index funds represent the largest percentage of the S&P and many other indexes. Isn't this a risk to the market? That's a really good point. I mean, every now and then when I'm at meetings with accounts and they ask me what could go wrong, I do actually mention my concern that index funds are owned by a lot of people who have no idea what's in them. They don't know that 8 stocks they used to account for 25% of the market cap of the S&P 500. If they own a growth portfolio, they may not know that those 8 stocks account for 50% of the growth index. If something happens out there that people just decide they want to be in cash, they don't want to take any risk whatsoever, and they just willy-nilly sell the indexes, then willy-nilly the market's going to go down no matter what's in there, whether the fundamentals remain good or not. So I am somewhat concerned about that. What really bothers me about the big index providers is the whole ESG situation, where that they're taking their market power and deciding how we should organize capitalism. But take a look at my book, In Praise of Profits. I try not to rant, as you know, but I do discuss that issue there. Finally, Doug, how's your book selling? You got some nice reviews. My book's selling well because I got some nice reviews, Doug. Thank you. Willem, my friend Willem. Okay. Willem's written some good stuff on Project Syndicate on the Fed and the mistakes the Fed's made and the policy options the Fed has. Willem himself is an ex-central banker. China's stock market just had its worst fall since 2008 because of a fear of lockdowns driven by Omicron. Do markets in the advanced economies assume that COVID is a thing of the past? Is this a risk? Great question. I mean, I think we all just want this thing to be over. And so to the extent that it's over here in the US and Europeans seem to be concluding it's over, that's a good thing. I think China made a big mistake here with their zero COVID policy, because it meant that they didn't get the herd immunity. And by the way, their vaccine isn't very, very effective. Our vaccine seemed to be more effective. Although now we got Chloe here, so we got a full house. There she is. Hi, Chloe. She'll start barking at me in a second, telling me I've overrun my stay here. Yeah, I think there's a supply chain risk for sure, which again is inflationary. It's all risk. I mean, it's hard to see how a real problem, if China has a real problem with Omicron, it's hard to see that there's anything good going on. And China, maybe what it does is it makes the Chinese feel even more vulnerable and more dependent on exports. But again, the export engine might stall if they can't get stuff out of the ports because they've locked everybody up using their zero COVID policy approach. Well, I apologize. I went a little too far, but there was a lot of things to talk about. Have a great week. Hope for peace on earth and goodwill towards all men and women, and pray for the Ukrainians that are suffering mightily, and find a good charity to contribute, because God knows these people need help for sure. All the best.